we're going to talk about a topic that is something that all startups, maybe if you don't even think, you're not going to think about it at the beginning, but it's something that all startups are going to have to deal with one day, which is exits. And I'm really excited because we have two people here today who have, been with companies that have been acquired this year, Kirsty and then Asi. So it's fresh in their memory about the experience, so they'll be able to share some insights with us about that. And then Dwight, who's worked with many different companies, high-profile companies who have gone through the exit process as well. So he'll be able to give us some insights into best practice and then mistakes maybe he's seen people make. So I'd love to just start off the conversation by talking a little bit about when should people, founders, or the C-suite team at a startup start thinking about an exit? Is it ever too early to start thinking about an exit? Maybe Kirsty, you want to start us off?
Yeah, sure. I, by way of background, Chief Investment Officer at Seedrs, and this year just last week we announced we're being acquired by Republic, a US platform. And in terms of that question, is it ever too early? There's definitely a point at which it's too early to be. You should never be building your business for an exit. I think we just heard Faisal say, you build a business for your customers. You've got to build a business that people want and a product that people want. And I think you always need to keep that in your eye. But I think it's never too early to be thinking about where do you sit in the marketplace and who should you be talking to, and having conversations with other players in your industry, even potential competitors. I know people are always terrified about that idea, but I think it's worth building those relationships. You can have conversations at high level about kind of where's the industry going, and you never know at what point that starts to become kind of a strategic conversation. Our exit was very much a partnership a couple of years ago. We do a lot of kind of co-raises with Republic. And then this year, with their growth and the Series B that they raised, it suddenly became a much deeper conversation about a potential acquisition.
What about you, Asi? Maybe you can talk about your experience and yeah.
Just I guess to echo that, I think that probably once you're taking your first dollar, either from an angel or definitely if you're doing a bigger seed or an A round, that idea of an exit is just there. It's constantly there, and I think that it could be a great source of focus at times, but it can be a massive distraction at other times. And I think that you just have to know how to keep it at the right level between the abstract and the concrete at different points of the journey. Because I definitely share the idea that you don't. While there's still, there's serial entrepreneurs definitely in Silicon Valley and in Tel Aviv that are basically building business for the exits. Like it's very, very clear to them how they're going to do it. The majority of other businesses, I hope still kind of come up with some real passion of a founder or founders to do something new, to do something meaningful, and then you need some money to get off the ground. Yeah, I think that there will be a time, and obviously once you are in bed with investors, then you have a lot of people with experience, and again, that could be very helpful, or it can be quite distracting in a sense that there's a lot of voices around the table. I'm a great believer that the right opportunity will present itself when you're ready, when the business is ready, because it is ultimately, probably one of the biggest but equally most personal decisions that you can find yourself making as a founder.
Yeah, definitely. And maybe we can, you touched on angel investing and VC investing. Like there's so much capital out there for founders now, right? And so it's easy to say, well, why do you even have to think about exiting right now if you can just raise more capital? Maybe Dwight, you can talk a little bit about, why make that decision, when to make that decision.
I think it depends really on the objectives of the company themselves. I think a lot of the companies we come across are looking for that growth capital timing. So they might be late stage or thinking we want to take the next step and maybe IPO. For a lot of more companies, it's actually they've made that intellectual leap. I think actually by and large they're doing it for the right reasons. I think they are looking to not just say this is the beginning of the end, it's the end of the beginning. I think that kind of next step, we had a company that IPO'd only, last month. They were looking to introduce growth capital, but also better governance. They wanted to have that kind of rigidity in terms of how they run their business. They wanted to be more accountable. They wanted to do more things. And I think from their standpoint, the IPO kind of gave them a good vehicle to do that. They also looked at, looking at the kind of the private capital, because there is an abundance of it. But I think they opted for plan A because it gave so much more to the actual business for that next stage of the journey, because it's not the end, it was the beginning.
Definitely. And then I'd like to delve in a little bit more around how you find that partner when you decide to exit, because of course both of you, went through acquisitions instead of doing IPOs. How did you, Kirsty, you touched on the fact that you had a partnership for several years with Republic, and how did that relationship evolve?
Yeah, I mean, in our case, it was quite an organic one. Those who know Seedrs may well know that we had a failed merger earlier in the year, blocked by the CMA. And, I suspected that probably put us a little bit on the radar of, okay, this is a company that is looking to do some sort of strategic transaction. And more people kind of came out of the woodwork, some rather opportunistically afterwards, thinking that we were maybe going for a fire sale, which we absolutely were not, and had a great year of business that put us in a really strong position. But that conversation just grew and grew, and we were looking at alternatives, like do we raise capital for ourselves, or do we do some sort of strategic transaction here? And the thinking on this one was that it all fell into place. It was a way to raise further capital for the growth of the business. It made sense as a tie-up. And, while it is a liquidity event for a lot of our shareholders, it's actually sort of not at all a kind of, I'm not necessarily seeing it as an exit for us. Management team are staying on. We're seeing this as we are now the European piece of this company, and it allows us to kind of continue that mission. And just keep investing in the products we like building for our customers here.
And just to delve into that a little bit more, you talked about the other merger that you were considering ultimately didn't happen. But what was the thinking at the the management level about, okay, this is the time that we actually want to think about one of these strategic transactions?
Yeah, I think it came down to scale. It's really about how do we get to that next stage, and what's the easiest way to do it? Is it raise capital and go it alone independently, or do we think we're at the point now where we can get there quicker and add more firepower with some sort of tie-up? Whether that, in the end, what we've done is a company that has a lot of the same product lines as us, but a completely different geographical market, very US focused. But I guess other things that we would be considering would be, is there another party that has the same customer demographic as us, the same geography, but a different product line? So you sort of have a strategic tie-up in that way. You kind of reduce your or you keep your cost of acquisition of your customers essentially the same, but you suddenly have multiple revenue streams to deliver to them. We've gone a different way in that it's just kind of it's I guess finding the synergies and expertise that you have of having a far larger organization behind you, but being able to access different customer segments and different markets. And for us in particular, the geographies are complicated. So,
right,
yeah.
exactly. What about you, Asi? I remember when we spoke on the phone a couple of weeks ago, you said that you'd never considered private equity as a potential acquirer. So that was kind of a new world for you. Can you talk us through a little bit about how that came about?
Yeah. So I think that, again, there's so many specific details. Depends on what sector you are, B2B, B2C, and probably 6 or 7 other kind of factors. But I think that trying to generalize here, at some point you can look for an acquisition with a trade or a strategic partner. So you're looking to be bought by either a much bigger company or a slightly bigger company, and then it's more of a merger than an acquisition in the M&A side of things. And I guess that as Kirsty started to touch on, I think that when you're going to that trade type of partnership or M&A, you're looking for that 1 + 1 = 3. Both for the acquirer and the acquired, and that should be the nature of the conversations. Like what's in it for everyone? Why is it good for both companies to go into that? For us, there was an alternative which I frankly didn't really consider until probably about a year ago, which is to go with a financial partner. And frankly, if you asked me about a year ago if I'll end up in bed with a private equity house, I'll thought you're talking crazy, because I had a very, very specific perception of private equity house. But I actually learned that yes, there's a lot of problematic people, should I say, in this part of the finance world. But there's also some amazing, especially mid-market private equity houses, which are generally just, I don't know, one level up from the VCs that we are familiar with. If you've been in your kind of A, B, and maybe C round, and so for after talking to a few, and actually, so we are a publishing company. I should have started with that, and in the 8 or so years of our existence, I've obviously built some relationship with the likes of Penguin Random House and Hachette and all of these, big global, multi-billion, 200 years old publishing groups, and it was very obvious from the outset for us that if we will continue to build the company, we will be very attractive to them because we present something very new and fresh and digital in a quite old school stuffy world. So that was always almost like the obvious route, and so the question was just when. And when the time started to feel kind of right, and I guess it's not just my personal decisions, it's when your investors want to cash out, it's how do you want to retain your team, it's where you are on the journey, really. I started to have some conversations with those big publishing groups and very quickly realized that I'm not ready to go and die in the cultural cemetery of 200 years old publishing, the global publishing group. And so the idea of partnering with a private equity house sounded actually quite lucrative for us because it provided the liquidity event that I wanted to create for my co-founders, for myself, for my team. But it actually allowed us to stay 100% independent. And so practically for us, from anyone that's not on the exec team, from a day-to-day point of view of managing the company, they did not see any difference whatsoever. So in that regard, it was a very, very smooth kind of win-win situation for us, where we provided more than a soft landing for our investors, and we're ready now to go with new investors and new partners, which are very much aligned in a sense that they're not like Series A investors looking for the 100x or the 200x. And so there's a much more alignment on the goals and the growth of the company and what we can achieve in the next 3 or 5 or 6 years' time. So it felt very organically, and obviously I optimized for great people that I want around my table and I can work with. And I found these partners with Graphite Capital, which are now our partners or controlling masters, depending on how you want to look at it.
Can I also ask you a question? Because we were talking about people before we joined the stage, and I think one of the kind of dominant themes this morning has been the people challenge.
Yeah.
And attracting and retaining great talent. Obviously, what was the perception of a PE owner coming in for your business, and has that kind of perception changed over time, or has it been something which you've had to really work hard on?
It's definitely something that I had to manage. Well, first manage my own psychology, and then manage my exec team psychology, and then the rest of the team. But it went very as smoothly as I could hope for. Obviously these things take time, so I had time to build a relationship and to talk to a lot of other portfolio companies, and learn that anything that I wanted to learn when I did my own due diligence. And I think that again there was a big difference in a trade type of acquisition compared to the private equity house, where the upside for everyone who stays is just much more significant in any possible way than if we were to go with a trade partner. And so it really came down to the people and the relationship and the partnership that we want to, and literally the people that we want on our board table. And so I focused very much on that, on building relationship to the point where when we switched it, when it happened, the graphite team came to our company, into our whole hands. They spent a couple of hours with the whole team. We had a brilliant Q&A session, and everyone saw that, okay, these are not just some crazy financial sharks as everyone kind of perceive private equity people to be. And since then, I mean, that happened in the summer. Since then, we just continue to work together, and we're actually quite enjoying it.
I'd like to put that question back to you, Dwight, obviously, because your job is
Yeah.
communications, right? So what are some of the mistakes that you see companies make in communicating, and I mean that in communicating to all stakeholders, right? Employees, to the market, all of those.
In terms of the big mistakes, I mean, it depends on the stakeholders. So we've had situations where prior to like an IPO, for example, the chief exec has gone on record and said, my company's worth 100 million quid. When it comes to the IPO itself, they managed to achieve a valuation of 35. Obviously, the perception then is it's a dramatic failure. And that chief exec sat me down in the pub that night and said, that's the worst day of my life, which is somebody who's done 2 tours in Afghanistan. Was quite interesting. That was the perception. He then was concerned about how do I communicate this and get my team and my people kind of excited about what was a really big undertaking for the business. But I think actually then it's the appreciation of the wider stakeholders. Obviously, the kind of the influence now of regulators. I mean, obviously we've got ARM and video situation kicking off at the moment. The introduction to CMA. Obviously, there's plenty of conversation about which assets should be brought under the umbrella of as being strategic interests. And so that you need to communicate to that audience, and also your internal piece. We probably do in an IPO process as well as an exit, probably just as much time with the internal audience as we do with the external. But yeah, I think that the challenge is that it has to be very holistic, but also it's just people always underappreciate how much time this all takes. How much the one thing that founders and chief execs don't have is time, and the one thing you need to commit is time, effort, emotional resource onto this. And so, no chief exec has said I started this too early as a process, but plenty of people said I wish I'd done this 6 months before.
So yeah,
If you think that Series A or your fundraising in general is time consuming and emotionally draining, 10x that when you're going through the full kind of due diligence process of an exit.
and how early do you want chief execs to be bringing you into it, and what does that process look like? working with
I
them?
mean, it's not uncommon for IPOs, for example, being a year ahead.
Right.
I mean, to a certain extent, that might be driven by the need to go and talk to certain types of investors, perhaps in the US. So they might be looking to try and build up business as usual communications. So when they come under the restrictions of 144A, they can say, well, that's what I've always done. I'm not trying to induce in American shareholders by doing my latest set of quarterly results or whatever it is. They're trying to create a business as usual, and also trying to make sure that the narrative is kind of it's understood by the market, and also you don't want the first time to kind of break cover it's the first time they've heard of you, because you can actually do a bit of background work with people like yourselves and say, look, this is always part of the plan. So when it happens, it's not a surprise, and there's an understanding that the growth capital is to this, that, or the other. And so I think the longer the better. And I obviously would say that because obviously I have a business that gets paid for that, but. I think to be honest, it's the longer. I don't know if it's different when it comes to yourself with your financial investor, but I think particularly if it's on like an IPO, you need probably a good year to think about this, because it's going to take a lot of time.
Definitely. How did you think through that communications challenge, Kirsty?
Yeah, I think probably what I learnt from our CEO the most in this was that communication to employees piece. I think I probably would have. I mean, it's. My background before joining Seedrs was in M&A, actually, so I'm sort of very comfortable with the concepts, and in general I'm someone that is inherently comfortable with uncertainty and change, I think, and I probably would have like massively underestimated kind of the impact on employees, and just that this isn't normal business for them, and they don't, you've got to be really like on it in terms of preparing them for what this means for them. And we went through, the distraction is huge, but we went through weeks and weeks of preparing kind of, FAQs for employees in particular. What are they going to ask? And, we had a PR consultant working with us, and that was not just the external comms, but also on that employee piece. She was brilliant at just sort of saying, these are the questions you're going to get, and things that you would never think of or just seem so obvious.
Like, for example, what? What were some of the questions employees had?
I mean, obviously, it's all about. I mean, the first thing is like, wow, so exciting, and then it's like, what about me? Like, what does it mean for me? You know, of course. And as much as you're like, it's not about you, it's about the strategy's the same. We're still going after our mission, but everyone very quickly you can see the calculation going on, and what happens to my options? As is my job safe? Or the kind of obvious questions like that. And we were in a blessed position, and that this is very much about. It's very much a growth transaction. No jobs are at risk, and it was leadership team staying the same. So pretty easy communication in that sense to make. But certainly in previous circumstances where it was more of a merger, on the same ground, then we spent sort of immediate comms as a full team as to what was going on, and then breakouts into sub teams and just going through over and over again, like this is how we see it, this is what's happening, this is the time frame, this is what's going to happen, etc. So I think just like over communicating that, like people, you've got to repeat the same thing 3 or 4 times because they're kind of surprised by the headline first, and then have to keep kind of driving home the message as to what's going to happen in the next little while to get to kind of completion.
Exactly. What about communication with investors and how you cooperate with investors through the process? You raised funds before you went through this transaction. I see. How was the relationship with your previous investors when you were talking through this?
It was generally very positive, but then again, because I was just incredibly fortunate to pick up the right investors, and so when I felt the time was right, I knew that they will back me with whatever decision I'm going to make. There were, few discussions on is that the right time, and some people were more keen to stay rather than to exit now. Some people again were just, you do you. It's your business. We're here to support you. But I mean, obviously, they have to sign it off and they have to be part of it, and they were very helpful in, helping me figure out that this is the right thing to do at that point in time for the company.
Mm-hmm. Definitely. What about you, Kirsty?
Yeah, we had a number of institutional shareholders, and bringing them along for the ride is crucial. They're very supportive, but I think understanding exactly your cap table and then how it's going to play out, because there are, we had different instruments in there, convertibles, preference shares, etc. And while there might be kind of support in general for the headline number, of course, when you get into the detail, that means a different slice of the pie for various people. There can then be kind of a, wait, what? And, if you agree to this term, it does that. So I think just understanding that and making sure you are consistently kind of communicating it back, it was crucial. But they were also very helpful, and I think very helpful. I mean, we had a couple of venture capital firms in us. I mean, venture capitalists are the biggest gossips going around. You've got to know this. So they are very actually helpful, though, sometimes in these circumstances. One, they probably will leak your deal, but on the other hand, they know what's going on in the market. They can generally know, like, is this firm also looking at someone else, or have they previously, and can often be quite helpful at back channeling to kind of the shareholders of that other company to sort of help smooth the way.
Definitely.
Yeah.
And what about, post-exit? Dwight, how do you help your clients prepare for the post, what comes after?
Well, a lot of it depends on the exit route you take. I mean, obviously, if you stay private, clearly the communication challenge is somewhat different. But obviously, if you go public, clearly you have commitments to the market, you have commitments to shareholders, wider stakeholders. It becomes that regular drumbeat. Every 6 months, you have to report your results. Clearly, there'll be trading updates. You'll have AGMs where people will obviously maybe vote on things and vote against things, and obviously that brings its own challenges.
Right.
But often it's about making sure you have a kind of clear, concise message to all the stakeholders, and one that actually doesn't deviate depending on the stakeholder, and it has longevity to it as well. I mean, clearly what you want to do is trying to be building to a kind of 3 or 5 year strategy, communicating progress along the way, and obviously using those kind of scheduled moments to kind of update the market. It does bring challenges because you have an internal audience who might have expectations of information flows. So sales teams who might have been used to seeing absolutely everything, suddenly they're not allowed to because they're being insiders. They might be shareholders. That obviously creates a different conundrum for people. But that communication challenge, to say it's something which you have to go with your eyes wide open because there is that scrutiny that comes from the investors. Clearly, the media are going to look at you, as well as obviously you're going to have people voting on your decisions as when it comes to a board. So
Yeah, definitely. And how did both of you think through that, post, what was going to come after? Maybe Asa, you can talk about that.
I guess because for us it was, I was trying to play it down as much as possible, both internally and externally.
Yeah.
I personally just never liked the whole big funding announcements and big exit announcement, and because we're all staying and we're all continuing to focus on the books that we make and the customers that we serve and growing the company, and that was really the focus. So I kind of wanted to. I worked on it for 6 months completely behind the scene as quiet as I could, and then we did the event, and then we did the internal communication, and other than a little, I guess, kind of debt of relationship that I had for the publishing trade press, we haven't done anything and actually tried actively to just keep it under wraps. And we kind of say, I mean, this is really the first time that I'm actually talking about it in public, because that's how we wanted to. We wanted to create an event that obviously is quite meaningful to a lot of people, but from the day-to-day of running the company, nothing really changed, and that's what we try to stick to, and it so far it worked.
What about how did you think through integration, Kirsty? You mentioned that the management team is of course staying.
Yeah.
How is that going to work?
We signed the deal a week ago,
Yeah.
and we're not
Yeah.
completing
Oh,
until
of course.
early next year. So I'm not even up to that yet. It's very fresh, but no, obviously we're obviously already talking about those things, but we haven't. And that's nice. We had sort of signing and an ability to announce, and then a delay until completion where we go through the conditions, etc. Which I think is nice in that you can announce the deal to the team before you're suddenly plastering new logos over their website and their t-shirts and whatnot. So that bit's still to come. But we are, I mean, like I say, it is our strategy that they have bought. They were very bought into kind of us, what we were planning to do in Europe over the next couple of years. So I don't see that changing a lot. The areas really that we're working on most for that integration piece is probably finance. So being able to have that kind of group view from completion, and people. What does it mean for people? What does equity incentivization look like for people going forward? They're all having their options moved up, and how do you level people across the two companies, etc. So I think they're things we're most focused on. In terms of integrating, I mean, we're kind of deciding now what are the priorities to integrate. They have some products that we don't have. We have some products they don't have. Where is it easiest and the most value to import those across? And where do they sit in priority versus our existing strategic plan of continuing to grow in Europe? Because I think, if we just focused on integration, we could go into a cave and you wouldn't hear from us for a couple of years and come out with a perfectly unified platform. And meanwhile, our customers have all left us. So, where we are, for us, I think the priority is business as usual, really, and growth in our market versus that full integration piece.
Can I ask, do you think, especially with the kind of partners or kind of people that you work with, I mean, communicating that kind of change to them might be quite difficult because you might have partner strategies, channel strategies, which you need to bring them on the journey. Is that something you had to work with as well?
Yeah, so we've absolutely communicated to all of them and very much had, I think, as you're sort of suggesting, a unified message to everyone, but tailored communication to what matters to them. But at the moment, it is sort of business as usual for everyone. And I mean, so far, what I see is it could only be a good thing for both partners and customers, because it's only a kind of a wider audience rather than any wind down of particular services.
Definitely. And in the case of, merger and acquisition, Dwight, I'd love to hear from you a little bit about how you help people think through that integration. Obviously, there's going to be two messages, right? Two voices. How do you help people with that?
I mean, the first concern, we had a very sizable deal in the UK market, which is the Aviva OSI soft deal, which was quite unique. Obviously, a UK business buying a West Coast asset, and principally the challenge for both of them is making sure that culture is maintained. I think this is probably something that you're both talking about as well, is that you need to make sure there is an alignment of kind of the actual cultural alignment needs to be absolutely spot on. There has to be complete buy-in.
Right.
That's the first and foremost thing, particularly for the tech companies, is making sure that there's a shared vision.
Right.
And there was a lot of courting, and actually through the actual the process of the actual acquisition itself, when they were courting OSI, they were up against some very big industrial companies who were looking to buy what was an industrial software asset. And a lot of time was spent just trying to make sure that the founder of this business felt like he was finding a kindred spirit.
Mm.
And beyond that, then you are talking into the more boring stuff like revenue synergies, cost synergies, communicating what cost synergies really mean from headcount loss, and revenue synergies, what that really means to the market. I think those things come after that initial piece of making sure that you've got somebody who shares that same vision. That's a big part of it.
Yeah, definitely. Interesting. And from all of you, if you could do the process over, for Kirsty and Asi, if you could do the process over again, is there something that you would do differently, do you think? Again, Kirsty, it's still fresh, right? But
up to this point, probably bringing in more external help. We sort of are somewhat blessed as a company in that we have a lot of ex-lawyers and ex-M&A professionals, and so we kind of did a lot of that in-house, but it's thinking it would happen quicker than it did. And then the distraction of that, that's not my day job. I have a team to run, and the distraction that leads to, and the kind of, where is she gone? What's she up to? Kind of sense that goes on, which you can get away with for a little while, and then when it kind of drags out longer and longer than you expect, that distraction is a huge burden, I think, on the business. Yeah.
Totally. Asi, what would you do differently?
Not much differently, but again, I think that you really need to understand how much completely out of the business of the day-to-day running of the business you are. As I said, it's like fundraising.
How much of your time did you spend on it when you were in that 6 months?
150% of my time were in that, and even if it's not physically being in the room with due diligence advisors, it was emotionally. I could not do anything else that is more internally facing. And so that means that you need to have a very strong and able executive team that will continue to run the business while you are in the thick of due diligence, and even before due diligence, obviously, having those conversations of finding the right partner. You definitely want to choose your M&A advisors wisely if you need them, and you probably need them.
So you worked with some advisors?
Yes, we did.
Yeah.
You want to, again, just optimize for chemistry, because you're going to spend many hours with these people. And start meditating about a year before, so you have a good meditation practice when you're getting into it.
It's so all-consuming, isn't it? And it kind of, even if you do have moments spare where you have the time to spend on the business, you're looking at the day-to-day problems, and it feels so small in comparison to this big secret you're holding and this big thing that you're chasing, and it's really hard to kind of focus back onto things that you kind of like, what can I do to push this deal forward? And that feels so much more important than anything else that's going on.
Absolutely. And I think, again, I guess that for companies like us, where we just by default, by culture, we over-communicate and we're extremely transparent. To actually be doing, something for about 6 months and not be able to talk to the company other than to my exec team about it, it's very tough.
Yeah.
Because you're feeling that you're just skipping something, and obviously people, can sense that something is happening behind the scenes, but you can't just share anything, until the deal is done. So it's tough.
Definitely. What about, Dwight, what's been your experience? What have some of your clients said that, they wish they did differently? Or what do you wish maybe they did differently?
I'm delighted that Kirsty is saying you should get external help. I'm delighted that you're saying you should be using M&A experts, given that that's what we do. I think the most unique piece of feedback I had from a chief exec through an exit was when they said, the one thing I wish I'd done is actually primed my family. So they spent all this time with the internal audience, the regulators, the investors, media, all the kind of good stuff
Yeah.
that I get paid for. But the one thing they didn't do is actually tell their family properly about what's going to happen, how this was going to change their lives. And the example he gave, which felt very awkward, was that he said, look, I wasn't prepared to having my wealth published in national media, that I was then a multimillionaire, and then my children's friends read that, and they obviously went to school, and they went up to my child and said, by the way, your dad's really rich. And it changed the perception. So I didn't actually talk to them about how this might change their lives, which kind of felt, as a kind of father, and I totally appreciate that. The kind of one audience you maybe forget is the one at home. And I don't know how it was for you, but that struck me as kind of a piece of feedback which is very unique. And I would say that to all chief execs, is make sure that all stakeholders does actually include the most important audience, the one at home.
That's super interesting. Well, we have a little bit less than 10 minutes left on the clock, and so I'd love to open it up to some questions from the audience. I know this is a hot topic, so let's go with this person in the...
Great discussion. So there's two, darker kind of topics that not many people speak about in the post-exit era. One being the founders' post-exit trauma, and the second one being the shocking fact actually that 70 or 80% of the deals don't go through. From your experience, are there any tips on how, as a founder, to navigate the post-exit era, both on the traumatic experience, which is oxymorous, I get it, and the second one being maximizing the likelihood to succeed within a bigger organization?
Yeah, though I'm not there yet. I don't know. I mean, having had a merger that didn't go through, it was definitely a challenge there to kind of bring the full team on that journey and roller coaster. But I'm not yet within a bigger company, so I suspect that Dwight probably has more experience on that.
Yeah, well, I mean, founder trauma sounds pretty horrific. And I think one thing we've kind of always made sure that we advise our clients on is having a very clear succession plan. So when that trauma turns into an exit of themselves. And most institutional investors will expect you to start thinking about that relatively early, particularly if say it's a founder-led business. I mean, we've seen plenty of businesses that have come to market recently with very strong founders who have kind of found the public spotlight to be pretty uncomfortable and maybe not quite what they signed up for. So having a clear succession plan without spooking people is obviously a major part of that. But yeah, we would obviously, that would be one of the things we'd advocate, is that trauma, if it turns into a need to exit, have that plan ready to go, not when it actually is the moment of crisis.
Totally. Well, you mentioned meditation,
But it's more specific, that always helps. More specifically, again, in our case, there wasn't any trauma because I optimized for a solution that will simply mean that the next day after the exit, nothing is changing, and that for me was good enough. I knew that I'm going to stay for at least 3-5 years that I think I have in me, and as long as I do that, I want to stay independent. Maybe if it will be the right thing to do in the next round, to team up with a much bigger organization. I hope not to. I hope that Wonderbly continue to stay independent for many years in the future. And as long as that is the case, I'm happy to stay. I'd like to stay.
Cool. Okay, we've got someone over there. Wait for the mic because we're going to be recording, so we need to get your beautiful voice.
Hi, I was curious about, as you were thinking about exit options, whether or not a public market exit was something that you considered, and if so, how did you weigh that against the actual choices that you ended up making, doing M&A, PE?
Kirsty, probably more relevant for you guys at that size.
Yes and no. I mean, we were still edging towards profitability, but still a loss-making, shareholder-reliant company. And in that case, I think an IPO is not always the best option to pursue. It didn't feel that was our... I think we would have gone for further private capital before we went for an IPO for us. Yeah. This tie-up was not that we were necessarily looking for liquidity yet. We were looking for scale and capital, and this transaction happened to bring both, plus some liquidity.
For us as well, just a bit too soon. But again, the move that we made now, the choice of going with the private equity, just mean that all the options are open for the next event.
Definitely. Okay, let's have someone else. Got someone right over there.
Hi there. I have a question specifically for Kirsty, actually, and building on the earlier question. Are there some learnings that you took from the failed merger, slightly more practically, if you are able to go into some more detail, that you applied going into the process with Republic? I can imagine it was quite a traumatic experience for your exec team. Going through something like that and then to come out of it, with a very unclear medium-term plan ahead of them relative to what they were expecting.
Yeah. So it's a really good question. I mean, the initial merger failed because the CMA essentially blocked it. So it wasn't that we did necessarily anything wrong in terms of how we kind of put that deal together. It was a huge shock, actually. Like I've been in the industry, put a lot of clients through that experience before in the past, and probably serves me right. But it was it did take me by surprise. I think others probably saw it and expected it more. So I don't know that I can take a regulatory learning away from that. I think in terms of the learning of preparing the team for that, we did have a plan B. Thank goodness, and kind of through that regulatory process and engagement with the CMA, it became clear that there was a risk, and so we worked with our shareholders on a funding round to sort of a kind of bridging round, should it not work out, and so we were quite lucky that kind of as soon as we announced that we had terminated the deal, within a week or so, we also announced we had further funding from our shareholders. And I think that gave the team a lot of confidence. And, as much as an executive team, it's, one deal is a transaction, one transaction is a distraction, but like multi-tracking like that is really difficult and can be frustrating when your CEO is telling you, we've got to do this, we've got to work on these two things. But it was absolutely the right decision at the time when there's that kind of risk. And it did mean that we were able to, I think, settle the team and say, look, onwards and upwards. We have new funding. It's back to our, previous strategy anyway. And we also then set out for them, okay, within the next 12 to 18 months, our plan is significant Series B or potentially alternative strategic transaction of some sort off the back of this strategic plan that we're going after. And I think we're very fortunate. There's a lot of work that went into it as well, but very fortunate that within a year we were able to announce that we had sort of succeeded on all those fronts, essentially. Yeah.
Okay, I think we
but
have
that
time
plan
for,
B for sure was important.
We have time for one more. There's someone over here. Awesome.
Hi, Matthew from Trusted House Sitters. Thanks for everything you've been, all the information you've been giving. Question really for Asi. I have a perception that mid-market private equity investors look for profitable businesses that have a kind of fairly predictable future profit stream and shy away from tech platforms that are scaling. Is that right? Was that your experience when you were?
Yeah, 100%. Yeah, I mean they're not going to invest in like pre-profit companies, as far as I know. It's an age-old industry. They've been doing it. They're just moving now into kind of more tech side of things, but they're very much specialist in companies that have reached about 5 million in EBITDA, and they want to help them to get to 20. That's kind of the sweet spot for them.
Okay. Maybe we can have one more. Someone else want to have something? There's one back there, Bill.
Yeah, so outside of price, what are the kind of deal terms to watch out for during an acquisition that can kind of screw you over?
There's so many.
we didn't have an hour for that.
So many. Where to start? I think people fight over things like warranties, etc. Just like it's so boring. But what you should really be looking at is any form of deferred consideration, and the terms around that. And you should expect that there will be an element of deferred consideration, particularly if they're expecting the sort of management team or founding team to sort of stay on, and want to kind of keep you there. So that's fine, but I think you just want to, deeply understand how that works, how you're incentivized in the year or two afterwards, how you're tied in to the business, what happens if you leave because you don't agree with what they want to do, would be probably the key thing that you want to go in thinking about, because it often gets added in towards the end, and if they want to ask up front.
Amazing. So we're ending on an important piece of advice to look out for.
Great advisors, great lawyers.
Growth advisors, great lawyers. Got it. Well, thank you so much, guys. We're out of time. And I just want to thank our amazing panelists. That was a really interesting discussion. I learned a lot. And yeah, thank you so much. After this, we're going to have lunch upstairs. So you guys can move upstairs. Thanks so much again.
Thank you.